This is a short clip on the impact of the federal budget when it comes to capital gains for medical professional corporations. I'm Jean-Pierre Laporte, the treasurer of the Canadian Physicians Pension Plan. So let's start with budget 2024. One of its purposes is to increase the inclusion rate on any capital gains that are generated by a medical professional corporation. Until June 25th, 2024, the inclusion rate is 50% of the capital gain. And after that date, it will be 66.6%. This also means that the capital dividend accounts credits will be reduced from the current 50% to a mere 33.3% as a result of this budgetary change. In other words, the tax-free capital dividends will not be as generous in the future. So let's do a quick example. If a medical professional corporation had purchased 1,000 shares at $100 per share in the past and decided before June 25th to sell them, and they're now worth $300, the proceeds of this position would be $300,000, but the capital gain is only $200,000. And because only 50% of that capital gain is part of the inclusion rate, the taxable gain to the corporation is only $100,000. At a 50.17% corporate investment tax rate, the taxes owed on the sale of those 1,000 shares would therefore be $50,170. It would also create a capital dividends account credit of $100,000. After we pay the corporate tax out of the $300,000 of cash, there would be $249,830 available inside the corporation to pay dividends. However, and this is, of course, we're not using a pension plan. However, after June 25th, because the inclusion rate has jumped from 50% to 66.6%, the same logic applies. The 1,000 shares are now worth $300,000. They were purchased for $100,000, so therefore the capital gain is still $200,000. But now 66.6% applies to that, so the taxable gains are $133,200. And if we apply the same corporate tax of 50.17%, because it's passive corporate investment income, then the taxes owed would be $66,826. There's still a capital dividend account credit of $66,660 because that's 33% of the $200,000 capital gain. So after paying those corporate taxes, the corporation of the physician is left with $233,340. And the difference between the taxes paid before June 25th and those after June 25th is an extra $16,656.44. Now, what if we introduced a pension plan through the Canadian Physicians Pension Plan? So again, after June 25th, if there is no plan, we've already looked at the math and we know that there is going to be $66,826 in taxes owed. But if we have a pension plan and we sell 1,000 shares to generate $300,000 in cash, but then we're allowed to contribute, let's say, $200,000 to the pension plan, that deduction of $200,000 is actually higher than the taxable capital gain of $133,200. So the taxes owed by the corporation is actually zero. And we still have our CDA credit of $66,660. So at the end of the day, because out of $300,000, we only took $200 for the pension plan, there's still $100,000 sitting in the investment account of the medical professional corporation. So this doctor does have the ability to declare a tax-free capital dividend of $66,660, meaning a no personal income tax payable. Now, that's not the end of the story. There's a bunch of other consequences that are beneficial. First of all, by removing that $300,000 from the balance sheet of the medical professional corporation, we've given that company additional protection against the tax on passive income that were adopted in 2018. This means that we can keep the medical corporation at the lower corporate tax rate of 12.2% on active business income instead of the higher 26.5%. Second, by removing the $300,000 from the balance sheet, we're also helping with the purification process in case the doctors wanted to sell the shares in order to claim what is going to be now $1.25 million tax-free lifetime capital gains exemption. And furthermore, and this doesn't apply to everybody, but if the physician decided to become a non-resident of Canada for tax purposes, by having removed monies from the balance sheet, the $200,000 that was put in the pension plan is now protected from the departure tax, which is a deemed disposition if an individual leaves Canada and becomes a non-resident for tax purposes. Furthermore, $200,000 that was contributed to the pension plan is now going to grow without any further taxation. In other words, even if the government decided to go from 66% to 75% to 100% inclusion, it would not make any difference to the corporation because the deduction provided by the pension plan would eliminate any increase in tax. Also, if the doctor is collecting pension income from CPPP in a country that has a tax treaty with Canada as a non-resident, the flat rate levied by the Canada Revenue Agency could be as low as 15%. There are about 100 countries where the tax rate is 15%, not the 53% that one would expect as a resident of Canada in a number of provinces. And even for those who are not non-residents that do decide to retire in Canada, if the physician has a spouse with no or low income, there's also the ability to do pension income splitting with a spouse. And that typically reduces the tax bracket that the physician is facing on their pension income. So if you found this interesting, I would urge you to speak to a specialist at CPPP. The best way is to visit our website and to fill out the form to be contacted by one of our advanced planning specialists. Thank you so much for your attention.